Hey, in this video, I'm going to talk about beneficiary designations for life insurance. So basically, this is in life insurance policy provisions. So besides that, I'm going to talk about other clauses like a common disaster and a spendthrift clause. So this usually when you have a life insurance policy, those things are included. So for the beneficiary designation, the beneficiary clause in the policy specifies that beneficiary is, as stated in the application or changed in writing or subsequently to issued to the policy. The standard provision states that any beneficiaries in the primary beneficiary class receive the death benefit before any other beneficiary. There's no limit to the number of the beneficiaries that can be in one class. So basically, for many type of beneficiary designation, you have a primary beneficiary and a secondary beneficiary. So basically, just to say is if you are the primary beneficiary, is the benefit gonna go to you first? Okay, if the primary beneficiary dies, the benefit will go to the secondary beneficiary. As long as the primary beneficiary alive, everything go to the beneficiary. So then how many beneficiary can be as a primary beneficiary? As many as you want to. So there's no limited number of the beneficiaries. The most common beneficiary arrangement is list the insured spouse as the primary beneficiary with the children as a secondary beneficiary. So this actually coming if you are very, very wealthy. So this is very important to set this way because you have a unlimited marital deduction. So this is very important for you to do that because you will not subject to the estate tax. However, if your kids as a primary beneficiary when you die, also the thing is going to include in your estate. So if you have significant amount money in your estate, you may subject to estate tax, which is 40%. So this is something in mind. So second is say the next most common arrangement maintains that exact succession but address the grandchildren as a third beneficiary. Certain problem can arise with both of these type of arrangement. If the children are minors, the court will not allow direct receipt of the money paid from the policy. However, after the court set up the trustee for the children funds, if the parents don't establish the trust, the children will receive their shares at age 18 in most states. So you can see, just be careful if you said if you want to list the minor as a beneficiary, you should set up a trust for that minor. So that's something, if you want to select a minor as a beneficiary. Then, for most beneficiary designations are revocable. This means that the policy owners may change the beneficiary of the policy at any time, include or exclude anyone. So this is very flexible, like on your retirement account. So you can, designate someone as a beneficiary, remove them. You can change that anytime. So that is revocable. However, there's a irrevocable beneficiary designation. This involve different rights and requirements. So in some circumstances, you may do irrevocable. So in this, when there's irrevocable beneficiary is designated, the owner must get the written permission from that beneficiary if the owner wants to do anything with the policy other than stop paying premium. And in some cases, divorce, if continued premium paid are court ordered, even this cannot be done. Okay, so well, if you no other reasons, you probably don't want to set up an irrevocable beneficiary. So basically, if your life insurance, you have an irrevocable beneficiary. You cannot borrow against that policy. You cannot surrender that policy. You cannot assign it. You cannot do collateral without the beneficiary's written permission. You can stop paying premium, so that's all you can do. But in other circumstances, you just cannot do anything else with that policy. It's not yours. Even it's insured on your life, but it's not yours. So that's something about beneficiary designation. So with life insurance provision, they coming up with other clause called common disaster clause and spendthrift clause. This is closely related to the beneficiary. Common disaster clause. It's very interesting. I found it's very fascinating. So you will know why, okay? So this is also called the payment delay clause. Say if insured and the primary beneficiary dies in a common disaster, even if the deaths occur as much as 30 days apart, the beneficiary is presumed to have died first. Okay, this is very interesting. Let's say your dad and your stepmom on a vacation, they travel, right? But they in a car accident. In a car accident, they both went to the hospital. Your dad died right away, and your stepmom died like 20 days later. Okay, so what are they saying here? Say, in this case, actually assume the beneficiary, which is your dad has $1 million life insurance policy. Your stepmom is the primary beneficiary. You are the secondary beneficiary. In this case, say is the beneficiary died first, which means say, well, if it's beneficiary died first, which means you are the secondary beneficiary. The benefit goes to the secondary beneficiary. This is why. Then you have to think about if there's no this clause. Basically, say if your dad died first, then your dad is this policy, death benefit gonna go to your stepmom. Your stepmom has a will, say her everything gonna go to her kids, nothing gonna go to you, so that you will not get this death benefit. Did you see why? So this automatically delivers the proceeds to the secondary beneficiary. This can be a good clause including in order to prevent the children from being inadvertently disinherited, especially in a case of the second marriage. So you can see here why this one have. This clause is, I think it's coming with the policy automatically. So it's called common disaster clause. If you are the secondary beneficiary, this is beneficial to you. Spendthrift clause. So this clause essentially prevents the beneficiary who may be presumed to be a spendthrift or otherwise unable to handle money. So if you give money, let's just say, the beneficiary is 25 years old child, then he just cannot handle the money. Once he get the $1 million death benefit, he gonna go to buy fancy cars, go to party, use all the money, within a year. So in this case, so it's spendthrift, right? Will prevent from assigning any benefits they may eventually get from insurance company. So this say, when it's spendthrift, this beneficiary may borrow lots of money, so they owe people money. So the people after them asking for money, so the beneficiary may assign the benefits to the the creditors. So it prevents this only while the insurer has the money. Once once it is in the hands of the beneficiary, there is no restriction on how they may be used the money. So basically, well, if you have a spendthrift as a beneficiary, you should not have you should not have them have a the payout option as a lump sum. You should set up the payout option as everything else. Let's say you interest only. You let the insurance hold the death benefit $1 million, then pay interest to the beneficiary. Then you can do a period, you say 20 years installment, or you do a month, say $50,000 per year a month, for the rest of the life of the beneficiary. So when there's a spendthrift beneficiary, you should not use the lump sum payout. Then this spendthrift clause is very important